Today's number is 93 because that's the percentage of economists that believe a rate cut is coming. But should we be focused more on the overbought statistics that we're starting to see on markets as hedge funds pile into long tech and potentially euphoria starts to take hold? Well, one thing's for sure, in today's video, we'll cover both the trading and investing aspects of the next couple of days into quadruple witching and why the options market is hedging itself for a big move. On top of all of that, the US dollar is starting to fall through the floor, and gold, silver, and many other hedges are going absolutely ballistic. Are we at critical? It looks like we are on several positions. Let's go through stocks, commodities, and cryptos as we cover everything that we need to know right now about markets. Well, welcome back everybody to The Daily Show. My name's Thomas Atkinson, and in today's video, we'll be taking a look at the data and of course the flows and the key levels that you need to be looking at. We've got plenty of excellent information, but let's get things started off straight away with the hedge funds, because it looks like hedge funds are making that age-old move again, and they're saying enough of this, we have to get back in. You may be aware, if you've been following the channel or even seeing these stats this year, that hedge funds have notoriously been slow to do a pickup on this V-shaped recovery we've seen so far. But now they've just gone in at the fastest rate that they have in almost 5 years. And funnily enough, this often does mark very key points in markets. The last time they actually did this was back in January of 2022, and we all know that didn't work out too well. So you can see here that sometimes they do go in pretty hard. They often do it to kind of basically say enough's enough, and sometimes it can be a sign of euphoria. And funnily enough, Barclays Euphoria Index just went off again, popping to levels that we haven't seen since some things such as the meme stock frenzy, dot-com bubble, and of course other reads. Now in recent years, we've seen much more of this activity, and that's because we'd never had so many retail traders, other than over here really, in the markets. And that means that we are pushing things around a little bit because we're actually making up a substantial part of these markets. And of course, the power of the 0DTE options has also led into some significant moves. Now, you would have already noticed that this year with all of the huge moves in things such as quantum stocks, ARK-K, Tesla just recently. We've got more to talk about that in today's show as well. And of course, congratulations if you've been on that one. That was a massive pop very, very quickly. And everything else. But are we actually just about to see the market start to spike with volatility? Well, according to Blue Curtic Market Insights, we're actually starting to see some interesting signs that suggest, yes, the next 5 days could be quite volatile. Number one is that when we see the VIX spike up quite a lot, so remember the volatility of the VIX market generally spikes when markets are going down or they're going up in a big way. But the VIX actually spiked up with only an S&P 0.4% move. Well, it turns out this is pretty rare, and when it has happened, you can see here that we do go into a little bit of an up, down, and all-around style market. And you might say, well, yeah, they're pretty close to 50%, Tom, but if you know anything about markets, generally speaking, markets are more bullish than bearish. So, of course, whenever you're getting a stat under 50%, it does make you start to say, well, okay, does that mean there is a little bit more to the bear tinge? Remember, these markets are currently overbought, at least on the short-term metrics. We'll talk about what that means for long-term investors very soon. So will we get a rate cut? Well, I think the answer is most likely yes. I saw a picture floating around that actually was all the Fed chair people having a sit around the table. They didn't look very happy, I'll tell you that much. But 93% of economists believe a rate cut's coming, and most people expect it to be a 25 basis point cut. I asked you guys, a few of you actually said 50. So yeah, you're probably smack bang on with what the betting odds market is, which is moving around a little bit at the moment. But you can kind of see the general thought process here, which is that 80% of people expect a 25 basis point cut and around 16% expect a 50 basis point cut. So yeah, will we get one? I think so. And I think this is the beginning of quite a few rate cuts that are going to come through. Remember, inflation could also be returning, but I don't think the Fed will care about this. And I also think that by the time we get into next year, you may be seeing a ton of rate cuts, depending on what happens, of course, with the chair people. Now, let's have a look here at the Fed easing cycle. We've got two reads that I think are well worth considering, because is it a buy the rumor, sell the fact in this case? Or, of course, it used to be a sell the rumor, potentially buy the facts. Well, unfortunately, we've only got two reads going back over the last kind of 20, 30 years, which actually shows us a period where the Fed has paused, not cut, and then cut later on 6 months later. And when they've done this, it's been both times a buy the rumor, sell the fact. Now, I'm not saying it has to be, but we do start to see a couple of things lining up here. Weird hedge funds coming in out of nowhere saying, hey, we need to buy lots of stock. That's usually not the best of signs. Then, of course, we've got an overbought market on the short term. And we also have that kind of sign of often showing us that, around the Fed cut, we do get a 50% style market. So a bit of a coin flip. Remember, anything under 50%, you're actually looking a little bit more negative than positive. So what happens next? Well, it all comes back to structure. If we do get a cut, remember, speed of cuts will matter. So if we get a 50 basis point cut, which will probably be a bit of a shock, it kind of suggests that actually the market might be a little bit weaker underneath. And it also is about leadership. So remember, if we see things like IWM, the Russell 2000, if we see mid caps guys, and they start to do better than the large caps over the next coming months, so make sure to sub to the channel because these next coming months will matter, then it suggests that we may keep going for a while, but that we actually could be entering into the dreaded recession. So why could that be true? Well, at the moment, it doesn't seem that way. Remember, margins tend to decline before recessions. It's very important to note that we are not currently in a declining margin. We're actually in something that is improving. And that is kind of one of those signs where you might say, yeah, but the economy is so bad. But we have to remember that the stock market and the economy are incredibly disconnected. So they're not the same thing. And of course, corporate profits are being greedily picked up by pretty much, all sorts of things, including lowering the workforce, which means that the Fed has to come in support, which kind of has like a net positive effect for the companies because they get to borrow at cheaper rates while the Fed tries to fix the unemployment problem. Now, Goldman Sachs, top down, they're believing that the market is going up. They're actually upgrading. So is Barclays, so is Morgan Stanley, JP Morgan. Everyone's upgrading the markets at the moment. And you may say, yeah, but these guys always get it wrong. I don't disagree. They made a big call this year. The tariffs came in, they cut everything. And then, of course, they decided, okay, the tariffs aren't too bad for now, so we'll upgrade everything. So you can take this with a grain of salt, but the point is they are upgrading across the board. And one of the reasons they're upgrading is a really strange factor here, which is that it's not the middle class or the lower incomes that are doing anything in the US economy. In fact, you can actually see by this chart that everyone's struggling in that area. You really can. Look at the consumer spending here. It's just straight back on the line. Whereas high income is loving life, and clearly very high income is really loving life, especially post 2020. Look at the difference here of what's happened in terms of spending. Okay, it makes sense that maybe a little bit more spending was going on here, but I tell you what, that is a huge divide. And funnily enough, a lot of this stuff actually happens at later cycles. If you're ever interested in finding out more about how this is all a repeating machine, and it does happen over 300 years throughout, of course, different economies in the world, whoever was the superpower at times, then definitely check out one of our courses, the Advanced Masterclass. I explain it all. I go through why this is happening again, and of course, the signs that we're starting to look for. But in terms of all of this, you can see here, and the links in the description down below. But in terms of all of this, we are starting to see significant signs of the middle class and lower class in America, at least, and I'm sure throughout the world, starting to struggle. Look here at delinquency student loans. So obviously student loans are back to having to be paid. Well, yeah, of course, that's going to spike back up, and it's now at a new high. Now, is this, of course, a problem? Sure, it's going to be one of those things. But again, at the same time, it's only part of the problem. Remember, we've got delinquencies in specifically cars. Subprime car is bad right now, but it doesn't blow up until there is a trigger point. So we have to, of course, keep all these macro things in mind, but not necessarily get too scared. Because remember, if the bonds market's not freaking out, why should you? They've probably got more information than you do. And that's why we track the bonds on this channel in different ways. And of course, at the moment, we're seeing US corporate bond spreads, they're tight. And that is not a sign of impending doom just yet. Could they spike up? And then I'm saying, well, wait a second, something's cracking. Sure, could happen next week. But at the same time, it's kind of like the calm before the storm. We know it's bad. a lot of you guys know. Some of you might say, well, it's awesome, man. Everything's fantastic. It's all good. All green, all good. There's some problems for sure. We can all admit there are a couple of issues. But at the same time, that we've got those triggers at the moment that are causing these companies to love life. New tax bills. Obviously, we've got the Fed probably cutting, and then QE and, of course, liquidity still being secretly pumped into the markets as well. So this week is triple or actually quadruple witching, which basically means that we have tons of different options expirations all happening at the same time. If you're unaware, generally speaking, at least the way I look at it, it's usually the day before that I look at volatility. So remember, at the time of this recording, we're Tuesday night in the US. So Wednesday is going to be the FOMC. That is the rate cut decision plus press conference. Then Thursday is usually a very volatile day because that's often where you see a lot of the hedging going on. So that's going to be a big volatile day. And then, of course, we come into the quadruple witching itself. So expect potentially large moves over the next couple of sessions. We'll go through that more in a moment. But I did want to mention that one of the things that's been happening in recent times has been that the NASDAQ has gone from kind of being a bit of a laggard to being, relatively strong again, which is fine. That's what happens when you get pullbacks in time. We've actually seen 9 positive days on the NASDAQ. Now, this is pretty big because when this has happened, this has actually led into some pretty favorable statistics when it comes to the next 9 months, 12 months, etc. And this is why I'm kind of saying at the moment that I always say with a bubble, if someone calls it a bubble, then it's not over. There's that famous quote. And at the same time, if someone calls it that the market is, too extreme or anything like that, you've got to ask yourself, is everyone all in? And of course, if we see sentiment surveys right now, if we see a lot of other things, yes, we are getting the signs of a temporary euphoria, but we are not seeing everyone all in just yet. There's still a bit of money on the side, and that's actually being represented, I think, by crypto the best, which we'll talk about in a moment. So, of course, September, will it be negative? Well, we've kind of already debunked the possibility that maybe it's not. We use Wayne Whaley's data, which we've had in the previous videos, and we'll bring it up again in a moment. But the main thing here is that, of course, remember, September, the last 2 weeks are generally bad, okay? They're just generally bad. They could be again, but we do expect volatility to come in usually the months of August, September, and October. So far, we've had August as being rotation, September's been stronger than normal, and then, of course, will October be the question mark? Well, what we are starting to see is other markets doing really well again. Silver, what a bonanza that's been. Now, we've been bullish on that very heavily for 6 months. I'd say it's been exceptional, frankly. It's been very, very good. Now, gold, of course, has broken its pennant. It's been on top of the world as well. And you can see here that central banks are buying these precious metals out of control, which is one of the storylines behind it. But we did just reach a critical level we'll look at later on. We've got some options positions as well, so you guys can see what's going on in terms of the options market with one of the major ones. But we've just hit 3,700. And you might say, well, what a big deal. You're thinking for 4.2. I am, but the RSI is high. And you've got to remember, if you take the distance here of a general symmetrical triangle component, that's A, that usually will equal B. And that points to around a 3,700 to 3,750 target. We're hitting the target concept just before the FOMC and quad witching. So that can mean that, okay, we break higher, or it can mean actually this is resistance and we're about to see an opportunity. And I often say patience, react, don't predict. And the reason we say that on the channel is because we want to take advantage of opportunities and sometimes have a little bit of powder ready for the right things. And we'll go through that a little bit later on. Now, cyclical bull markets, are we on the track of a normal bull market so far? The answer is yes. Could we go further? The answer is generally, I think so. And of course, this basically suggests as well that it may still be a little bit of a while away before the people that want a recession or at least think the recession's coming is going to come. Now, it can change just like that. I mean, recessions come out of nowhere and things happen. But at the same time, the current evidence we have suggests that if there is a freak out in the markets, unless it's caused by the wrong things, and it depends what it is that it causes it. If it's just a buy the rumor, sell the fact, then we probably don't necessarily need to worry just yet. Now, where is the weakness going to be? As we suggested, Wayne has done some interesting data stats. I always like his stuff because it's more to the times. So it's actually based on the current year and the current information we're getting from the market. Remember, structure, quant, this type of stuff matters. So as you can see here, after a 5% summer, June to August, we do tend to see 6 to 18. So basically this means that only 6 times to 18 negative times do we see the market up. Now that's actually pretty big. And that suggests that October could be the more volatile month this year. Again, a guess, but it certainly could be. And that's something, of course, we'll be paying attention to. Now, we've mentioned crypto and its basic themes quite a few times. We'll go through that later on today's video. But let's start off here with the S&P for a moment because it is overbought by some short-term metrics. And what this generally suggests is that pretty soon, whether it's today, tomorrow, the next day, or even next week, there's going to be either a sidewaysing market or a bit of a pullback. And this is something that we've seen before quite a few times in the markets over the last year. And specifically, we've had it 1, 2, 3, 4, 5, and now 6 times. So it's been pretty decent. And the way I'm looking at this market right now is, well, here are the updated options high and lows, is that if we do get pullbacks, there are a couple of key levels to be watching. The first one's going to be 65, kind of 20, I guess, at this point. And the reason it's going to be that is because this is a mixture of VWAP, 20 moving average, and in general, just kind of like a level that we often see kind of get bought up. So it's been happening before, so you've got to expect buyers to be here. But would I be buying at 6,600? I know it's positive gamma, but I don't know if I could buy the index here. I think for me, it probably wouldn't be the right kind of call. It may end up more bullish. Of course, that's fine for the positions you're holding, but you've got to think about when you're putting a new position in the market, do you have edge? And you might say, well, Tom, look at this. It's a shooting star, man. It's going to shot off. I'm going to sell it. Hey, you might believe you have edge, but of course, most of them have been bad. Because of the read we got over the last 24 hours, it's better than it has been. But yeah, the first level here is 65.20. Second level is around 63.50. And third level, and probably where I expect major support should we get down there, around 6,200. So let's have a look if that feeds in with the options. Well, you'll notice here there are lots of puts and there are a bunch of calls as well. It's clearly a market that is hedging itself to effectively a larger coiled move. So we are in positive gamma at the moment, or we have been anyway, above the 6,600 level, but it's becoming more neutral due to the options over the next 24 hours. So the real question is, if we fall through, will it be kind of fierce? You'd have to expect so. If we go up past maybe a 66.40, will it be pretty fierce? You have to think so, because there's a lot of options that are sitting in these ranges. So we're very coily trapped in terms of markets. Now, that can also lead to nothing happening, although I don't expect that this time because it's trapped within these two zones. But yeah, quite a lot of options. You can see they're a little bit bigger in terms of size than a standard day. And this all will probably go down between 2 and 2:30 p.m. tomorrow. So that is on Wednesday. In terms of the next couple of sessions, you can see it's overwhelmingly more call-like, and we'll be paying a lot of attention to all of that as well as we go through it. All right, let's now break down what else has been happening recently. So we've got Tesla here. You can see that's been incredibly bullish. This one went super positive gamma, pushed into like 426, something like that, because Elon, of course, bought $1 billion of his own stock. I kind of liken that to one of the best trades of all time. If you think about his holding, actually, his overall holding then going up quite substantially of that. But you can see there are two levels that are starting to appear, 450 and 470. So that's based on the options. And these little 900 people, I laughed at them, but maybe they're going to have the last laugh, guys. I don't think so. They've expired quite a lot of options over time, but still, there are some insane options at $900 in the future. So we'll see how those ones go. But yeah, 450, 470 on the options call walls moving forward. NVIDIA still hovering between 170, 175, 180. So not too much updates there. You guys can see it. And I thought I'd include GLD for today because I want to really show that, yes, there are quite a lot of calls on this level here. For this 3,700 level equivalent to, of course, gold spot is actually quite well struck. And what that's telling us is that this is a pretty important level for gold. So if it breaks up, maybe it goes more ballistic, but it is a resistance. You've got to think of it as a resistance or a call wall issue for the markets. Another one is options, and of course, Bitcoin. We've been pretty bullish on this, and so far so good. Positive gamma. You guys have seen the power of it along with the good technical analysis. So it's been pretty nice and it continues to look pretty good. I wouldn't mind Bitcoin to come back down and get us a level we'll look at soon, but yes, certainly has been improving. So then the question is, are we still in a bull market? Well, the answer is quite simply at the moment, yes. Generally speaking, if you were looking at a market that was actually really going bad, you would see things like staples actually start to pick up before. So you'd see a little bit of Wall Street sneaky moves. This is what we call a defensive move. So they move defensively ahead of announcements if they're really worried about, a more deeper, horrible pullback they're not going to buy. They're just not doing that right now. Staples is moving down. So that's kind of leading into making you have to think that overall, the market is feeling bullish about itself. Same thing here. Consumer discretionary versus staples. 1/3 of the economy is of course consuming in the US. Well, look at this. It's going up. It's not bearish at this stage. And then of course, we've got the cryptos as well. We saw Solana break out and hit 250 last week, and that was of course again risk on. There are certain things that are risk on. We've also seen ARK-K, really picking up quite a lot, mostly thanks to Tesla, but that's been improving for a while and breaking up higher. So again, this is kind of that risk on coming into the market. So it's not so much that, we can argue all day whether the market is overpriced or not overpriced or whatever. But I always go with the idea of, has everybody already come in? Are we looking at a temporary sell-off if it does happen, or a big one? I think at this stage, the evidence at least is breaking towards a temporary. Now, what about IWM? We can see again the NASDAQ started to pick up because IWM fell against the NASDAQ. Now, I expect IWM to potentially have some rather large moves in it to the interest rate because it's probably the most sensitive really to rates. A lot of those businesses are pretty sensitive. So we'll see how that goes. But this will be an important read as well. So make sure to check back after the FOMC. So we give you the update for that one, guys. And of course, Treasuries is powering higher. We think next stop is probably 92, 92.50, and then potentially 101. Expect Treasuries to potentially move a little bit over the next 24 hours. But probably the story that a lot of people have been looking at is the US dollar. Now, everyone makes out the US dollar is dead. No one cares. No one likes it. There's definitely hedging going on. So there's a chart. I don't think I've got it in this video, but we'll put it in the next one, which basically shows that people are buying US stocks, but they're doing it over at a point where they're hedging the US dollar. So they're concerned about the dollar, but they like the stocks. And this has become a really big thematic here of 2025. So here are the rejections. Obviously, on the weekend video, we talked about how we thought it was going to be weak dollar this week because of the very good setup. And this has actually played out so far on quite a few currency pairs. So we've seen the euro break to an upside. That's actually been a good pre-trade here for the FOMC. How's it end? I'm not sure. But then we've got the Aussie, which is, I'm Australian, so this is where I'm from, and it's breaking on their way up. So a lot of currencies going against the dollar, that is strengthening against the dollar, and that has certainly been a story. And it'll be interesting to see whether it keeps holding it because they're all breaking up. They're not really hitting resistances, in my opinion, but gold kind of is. So this was, of course, our first target for a trade, gold. So if you did that, well done to you. Now, of course, macro-wise, I'm greedy, so I want more. Why? Because I think there is a longer-term schematic kind of concept here. But gold certainly hitting that first critical level, which is a mixture of this kind of 2/3 move through, and we're really hitting into that right now. So gold, I'd say, hits its first target. It's at critical resistance ahead of big news. We also saw silver get basically to 43, which if you've been watching for a long time, you will know that 42.43 was a zone that I've talked about since the 20s. And the reason why is because this is a critical old school zone. And while I think we're going to 48 plus and all-time highs for silver, it may be a point where it takes a little bit of a breather. Again, long-term investor probably doesn't care. The short-term trader, maybe you care. US oil, it broke up, so it's suggesting that maybe oil wants to go a little bit higher here. And this is kind of like maybe an undertone. So think about it. We see rate cuts. Maybe oil starts to spike. What's the story? Oh, inflation could be coming back, and that type of thing. You know what I'm saying? So maybe that's happening on the barrel, but price action certainly has improved. It suggests that pullbacks may be met by bull demand and that maybe stop losses underneath this level are safe for now. we'll find out. But yeah, certainly an improvement. First target 66, second target would be about $70 a barrel on that one if it does keep going. Then there's Nvidia, caught in the middle of nowhere. It gapped down, gapped up, gave us an island reversal. Obviously, a lot of people got very bullish on it fundamentally, and maybe it improves. Of course, we don't know it's really on top until it goes past 185 and gets back into that super positive gamma flow in terms of the options. But at this case, you can see here, it's just trundling along, waiting for that next big move. Now, if you look at semiconductors, so if we put semiconductors in the charts, you'll notice they've held higher. So again, it's suggesting at the stage that, yeah, it's still risk on across the board, and pullback's probably going to be met by bull demand relatively soon. We've given the key S&P levels earlier in the video, of course. Now let's have a look at Tesla. Pretty positive. It's going crazy. So, of course, 450 now from the options. This is an option stock more than anything else. So you can see here, options 450. And then, of course, we had that other level up here, which is that all-time high zone. So is it all-time high, actually? Yeah, it is all-time high. So these two levels are interesting. At the moment, you wouldn't want to bet against it. But I would say I wouldn't chase a stock like this because if you're on, it's cool. If you want to chase it, look, be my guest. But the thing is, it is always about, where's your risk management in these procedures? And of course, because it moves so quickly, you're going to pay more premium. Now, what about the Hang Seng? Well, the Hang Seng has certainly improved. I am, of course, bullish on China, mostly because of liquidity. I'm just looking at the central bank and saying they're pumping. And generally, where they pump money, markets go up. So that's certainly happening, and it's improving. And of course, we saw Jack Ma, famously, of course, the founder of Barber, coming back up out of nowhere. So he's back, guys, and that's leading Barber up. And it's also just leading a general resurgence in price valuations for China. It's not going to get to the point where it's US, but it's just improving in terms of people are starting to say, oh, well, these companies kind of cheap and, blah, blah, blah. So it's all happening. You can see there's risk on. We've been talking about for ages. US 2K, almost at point critical ahead of the FOMC. 2400 is, of course, a psychological level, but yeah, we're give or take very close, 80% of what we expect. Some people will want to close targets here and say, you know what, I'll wait till after the FOMC. If you're a trader, near enough is pretty much close enough in this case. But as I said, patience, react, don't predict. I think there's going to be an opportunity on the horizon post FOMC on one of these pairs. And then, of course, you've got NASDAQ, which is very bullish. I mean, the thing looks ridiculous. It doesn't look like it's kind of weak. It is overbought on some metrics, but again, that'd be a prediction more than anything else. And of course, we go back to Bitcoin. Levels to watch if it does come back to 110, 111. So this level here is going to be, I think kind of important if we do see a pullback. And at this stage, of course, the options world is looking pretty good towards Bitcoin and the other cryptos. So it's kind of pushing higher. And the reason I say that the crypto world may have a little bit more to tell us about what's going on with the stock market and everything else is, remember, in previous halving cycles and in previous bubbles of crypto at least, you have to have the euphoria. And where does the euphoria come from, guys? Pause the video, put it in the comments down below. That's right, the crap coins. So we haven't had a crap coin run recently. And there are some, but not the entire gamut of crap coins. So I would like to see kind of that, because what that is it's pure speculation. And you might say, well, it's speculation anyway. Some of these things don't exist. I guess I get you. But at the same time, it has to be pure spec. So pure spec is not here yet. And that suggests to me that there's still more to go, even if we do get a rough back end of September, October period, unless it's driven by the wrong things. And remember, it's policy that's doing this. So speaking of policy, it is the FOMC that everyone's watching. This is going to be at 2 o'clock New York time, 2:30 for the FOMC press conference. And then, of course, we have Thursday, which is the pre-OPEX day. This tends to be the vol day. So just remember, volatility can be quite fierce. It does tend to be more bearish on that vol day as well, I will say, on Thursday. And we'll see whether it happens the same way once again. If you enjoyed today's video, then please remember to subscribe, smash that alert button, guys. Check out us on X as well. Follow me on LinkedIn. I post over there quite regularly under Thomas Atkinson. And you guys can also check out our courses if you're interested in finding out more about the cycle theory, how this is a repeatable process, how you pick certain things into the end. Then, yeah, certainly check it out. The advanced course, I think you will enjoy. Thank you so much, guys. We'll catch you for now. See you in the next one.